Hey everyone, and welcome to this explainer. Today we're dissecting the anatomy of fiscal policy. Now, if you're studying macroeconomics, you already know that our models often present this beautifully clean, frictionless world. It all works perfectly on the whiteboard, right? But today, we're going to bridge that gap between those pristine equations, like the classic ISLM framework, and the incredibly messy, high-stakes reality of actual government intervention. Economists absolutely love a frictionless model. But as we're going to see, policymakers operate in a world of pure friction. Let's get into it.
Here is our game plan. We'll start by defining the scope of fiscal policy. Look at the actual instruments and mechanics at play, and then dive deep into the crowding out controversy. After that, we'll hit some extreme theoretical cases before wrapping up with real-world fiscal limitations.
Okay, Section 1. Let's establish our baseline and define the actual scope of fiscal policy.
At its absolute core, fiscal policy is just the government making choices about how much it spends and how much it taxes. And unlike monetary policy, which is handled by central bankers, these fiscal decisions are made by elected politicians. Think the US Congress or the British Parliament. Now, in our macroeconomic models, we usually treat government purchases and taxes as exogenous variables. Basically, by holding these variables constant outside our core model of national income, we can cleanly isolate them. It's like putting them in a petri dish. This mathematical isolation is what lets us trace exactly how households and firms react when the government suddenly decides to inject or withdraw capital from the broader economy.
So why do governments pull these levers in the first place? Well, the main goal is macroeconomic stabilization. They step in to steer the economy out of deep recessions or to cool things down during an overheating boom. The ultimate targets are maximum employment, stable prices, and moderate long-term interest rates. But it's not just a simple checklist you can tick off. These are often competing mandates. Chasing maximum employment through massive stimulus can totally threaten stable prices. It's that classic Phillips curve dilemma we all know, where solving one macroeconomic headache literally exacerbates another.
Section 2. Fiscal instruments and mechanics. Let's see how they actually pull these levers.
The toolkit really boils down to three main variables: government purchases, taxes, and transfer payments. And it's absolutely crucial to distinguish between purchases and transfers. Government purchases of goods and services actually consume resources. They directly add to aggregate demand. Transfers, on the other hand, like Social Security checks or unemployment benefits, they just redistribute income. Their actual impact on the economy completely relies on the marginal propensity to consume of the people receiving that cash. Together, these tools dictate the budget. If spending eclipses taxes, boom, you've got a deficit, and the government has to borrow from financial markets by issuing debt. If they collect more than they spend, they're running a surplus.
This table is fantastic because it brilliantly illustrates the mechanics of how different fiscal choices shape the economy. Look at how an income tax cut, an increase in government spending, and an investment subsidy all successfully raise overall GDP and interest rates. But, and this is the key, their underlying impacts are wildly different. A tax cut boosts consumption, but actually depresses investment. Direct government spending, that also depresses private investment. But an investment subsidy raises consumption and investment alongside GDP. So the takeaway here is massive. How a government chooses to expand the economy completely alters its structural makeup. It really goes to show how highly targeted government action can stimulate rather than suppress the private sector.
But obviously, these policies don't operate in a vacuum. Which brings us to Section 3, the central friction in macro policy, the crowding out controversy.
Let's trace the domino effect of a government stimulus. Step 1. The government ramps up purchases without hiking taxes. Step 2. To pay for it, they have to borrow. So the government waltzes into the market for loanable funds, going head-to-head with private firms for a limited pool of domestic savings. Step 3. Because the government is sucking up these funds, the price of borrowing, our equilibrium interest rate, shoots up. And finally, Step 4. This higher interest rate makes it way too expensive for regular businesses to borrow and expand, so private investment drops. The government spending has literally crowded out private investment.
We can see this exact phenomenon perfectly visualized in the classic ISLM framework. A fiscal expansion pushes the IS curve outward to the right. But if we assume a perfectly vertical LM schedule, meaning money demand doesn't care at all about changes in interest rates, the new equilibrium just slides straight up. Output, or income, stays completely flat, while interest rates spike aggressively. Because the money supply is fixed here, government spending displaces private spending exactly one for one. It's total 100% crowding out.
Now you have to ask yourself, is this complete one-for-one crowding out actually likely out there in the real world? Usually no. If an economy has a lot of unemployed resources and money demand does respond to interest rates, that LM curve won't be perfectly vertical, so you only get partial crowding out. But wait, the plot thickens. What about crowding in? Imagine government spending is super targeted, like building new highways or a massive broadband network. That infrastructure actually makes private firms more productive. By raising the expected returns for these businesses, public spending can induce higher private investment. The accelerator effect kicks in, and suddenly you've got crowding in.
Section 4. To really grasp the theoretical boundaries of this debate, we need to contrast two extreme academic scenarios.
Picture two polar opposite worlds. On one side, the liquidity trap. This happens when nominal interest rates essentially hit zero. The opportunity cost of holding cash is zero, so the public will just absorb any amount of money supplied. The LM curve goes perfectly horizontal. In this scenario, expansionary fiscal policy has a massive, maximal multiplier effect on income, and interest rates don't budge. Zero crowding out. On the flip side, we have the classical case. That's our perfectly vertical LM curve. In this world, increasing government spending does absolutely nothing to the equilibrium level of income. It just drives up interest rates and causes total 100% crowding out.
Section 5. Theories are neat, but as we've said, reality is a whole different beast. Let's look at the practical limitations when fiscal policy hits the real world.
The 2008 and 2009 financial crisis is basically the perfect historical laboratory for all of this. Central banks aggressively slashed interest rates until they hit that zero lower bound. They literally pushed the global economy into liquidity trap territory. With monetary policy essentially out of conventional ammo, the burden of saving the economy fell entirely on fiscal policy. This was a high-stakes, real-world test of the fiscal multiplier. Suddenly, the academic debate over liquidity traps wasn't just in textbooks anymore, it was playing out in the halls of Congress, with massive trillion-dollar spending bills meant to prop up aggregate demand.
But of course, there's no such thing as a free lunch. Deploying that kind of massive stimulus came with severe side effects. Budget deficits exploded, and government debt levels went through the roof. And for you advanced students, this brings us right to the concept of sovereign risk. Deficit spending at that scale can eventually cause bond yields to spike because global investors start demanding a risk premium to hold on to increasingly risky government debt. We saw this play out in August 2011 when Standard & Poor's actually downgraded the U.S. government's credit rating below AAA for the very first time in history.
And that leads us to the incredibly dangerous intersection of fiscal and monetary health. Legendary central bankers, guys like Alan Greenspan and Paul Volcker, were always warning about this friction. It touches on this terrifying concept called fiscal dominance. That's a scenario where a fiscal authority racks up so much debt that the central bank is basically forced to print money just to monetize it. Once the public catches on that a government might try to just inflate its way out of its debt, long-term inflation expectations become completely unanchored. And when that happens, economic stabilization becomes almost impossible.
So, I'll leave you with this final provocative thought. When the next severe economic shock hits, and it will, how do policymakers actually walk the tightrope? How do we balance the absolute necessity of short-term fiscal stimulus to avoid a depression while simultaneously dodging the crushing, destabilizing weight of long-term national debt and sovereign risk? It's the ultimate macroeconomic balancing act, and there are certainly no easy equations to solve it. Thanks for joining me on this deep dive into the mechanics of fiscal policy.